Okay. Good morning, everybody. This is the Live Market Open for December 7th. It's a Wednesday, as usual. I'm Yohay Elam of Forex Crunch and Market Movers podcast, doing the show as usual for FX Street. In today's show, we'll cover recent developments in markets. There have been quite a few, I must say. As usual, we'll discuss charts and levels of major pairs, minor pairs, and crosses. We'll dedicate a special segment to the big event of the week. That's the European Central Bank's decision. We'll do a preview of that. And our currency of the week is pound dollar. As always, we'll conclude the show with the week ahead, which features this time the Fed decision, and as usual, wrap up the show. And of course, your questions are always more than welcome. If for any reason you cannot see the chat box alongside the screen, please go to the address here, tlk.io/fxstreet-forex-live-video. Okay, so let's begin. What's going on in markets? There are quite a few things on the agenda. Next week, we have the Fed decision, and everything is set for a Fed rate hike. Recent members of the FOMC have been speaking, and they made it clear that that's what's going to happen. Okay, we had Yellen beforehand, we had good data, we had the meeting minutes. Everything is leading in a very prepared, very organized fashion towards a second rate hike, the second one in a year. Last one was December last year, so it's some kind of a Christmas present from Yellen, if you wish. But what's going to be next, what's up ahead, that depends a lot on Trump, that depends on the economy, and that'll be the main focus of the event. So for now, the Fed is sort of more of a sideshow, but rate hike is fully priced in for now. Italy, we talked last week quite a bit about the Italian referendum. There are fresh worries. Initially, what we had there is that Matteo Renzi, the prime minister, lost the vote spectacularly. 60% said no to the constitutional changes and 40% said yes. Okay, that's a big blow for his efforts. We knew that he was going to lose according to polls. It showed some kind of a 10% gap, but not 20. And he resigned as expected. He honored his pre-referendum pledge. Okay, and initially we had euro dollar. We can look at the chart immediately. Actually, we had euro dollar plunge. We had euro dollar fall, even breaking temporarily the double bottom of 105.10, 105.20, reaching 105.10. Okay, but that was a false break during the Asian hours. We have here the daily chart, and afterwards we had an impressive recovery. We had the pair even rising to new highs. So we almost touched 108. Okay, that's also no, the euro dollar also took advantage of the ongoing correction in the US dollar. For some reason, the screen does not refresh. Anyway, and we had this kind of buy the rumor, sell the fact, riding on the weakness of the US dollar, and reaching a conclusion that maybe it's not that bad. Okay, but after the dust settled, and we don't know what kind of government we're going to have in Italy. Afterwards, we had, I think yesterday, rumors that Italians will go to vote once again in February, maybe. There's high uncertainty for the banks, especially Banco di Pesci di Siena. Hope I'm not butchering the name, but also other bigger banks than this oldest bank in Europe have some issues, and without running government, without a strong mandate, things look a bit more dark, a bit darker. Anyway, at the moment, let's look at the euro dollar chart once again. I have it now. We've seen this dip and then a wild recovery above the previous levels, above the previous sort of the cap of the range, sort of the highest level, if you wish, after Trump, after the U.S. elections, which were a month ago already. A month has passed, and here we are. So we're seeing this break above 106.90, getting close to 108, close but no cigar, and now once again falling to the old line of 107.10, which was a line of support back in December last year. Okay, so we'll talk about the charts later on in detail, but that was quite a big move in euro dollar. I'm happy to see that it's the world's most popular currency pair, and it tends to trade in narrow ranges, unfortunately. So this week we had a lot of action there. The big event of last week was the OPEC meeting. So there were lots of rumors during the days leading to this event and on the day itself. And finally, the Saudis decided that they're going to make their big effort despite some opposition from Iran and Iraq. So the Saudis accepted, they decided to cut more production than the rest. Anyway, we had an announcement last week, quite ambitious, to cut 1.2 million barrels per day. That's the MBPD. To 32.5. Iran, Iraq, United Arab Emirates, Kuwait, Nigeria, other countries, and of course Saudi Arabia will cut. And the agreement is contingent on some cuts from non-OPEC members, most notably, of course, Russia, but also Kazakhstan and Mexico. So there are follow-up meetings coming soon, and there are high hopes that also these countries that are not part of the oil exporting consortium, they'll also join in. Okay, so this has had quite a significant impact on oil prices. I must say I was personally quite skeptical given their recent past in the past 3 years. We did cross with WTI crude oil the previous double top of just under 52, but never went too far. First of all, there are doubts about the participation of non-OPEC members. Secondly, there is, well, still quite a huge glut. Still quite inventories are just too high all over the world. That's the members of OPEC, the Saudis, the others did mention that they want to chop down this mountain of oil inventories, this glut, which is weighing down on oil prices. So if you can see here, this double top, and we had a break above it. That was actually on Monday this week, and we're back down, still above $50 per barrel, but not going too far. It's also important to remember that the U.S. shale industry is always there to ramp up production if prices rise, and if prices fall, they'll squeeze their production. So this flexibility is one of the reasons that oil prices are relatively moving in range. Okay, if you look at percentage points, it's not exactly ranges, it's high volatility, but if you look at the changes in dollars in comparison to previous years, and then oil prices are in a stable range. Okay, we talked a lot about these big issues. Oh, I have a B missing here. Anyway, there's tension growing towards the ECB, European Central Bank. We'll have a full preview of that later on, and hopes for a soft Brexit in the UK, of course, with its relations with the European Union, are pushing the pound higher. Once again, we'll have a special focus on pound dollar. We'll tackle it from all aspects. Okay, see if there are any questions. No. Okay, so let's continue with events coming. With the data, not only the big events. We had, of course, the non-farm payrolls on Friday. So I was talking up to now without mentioning an event that is usually the king of trading. That's because the Fed rate hike is basically priced in, and the non-farm payrolls did not alter the path of the Fed, were just good enough. 178,000 jobs were gained in the month of November, basically as expected, even a bit above that. The disappointment came from wages, which after rising 0.4% last time, they retraced, fell 0.1%. And year over year, we finally broke this top of 2.7, reached 2.8. We're now back to the previous range of 2.5. So it's two steps forward, one step backward for wages. I think the U.S. economy in general is on the right path, but it's still kind of slow growth also on wages as in other aspects. The unemployment rate, if you want the good, bad, and the ugly, and then we have 178,000 jobs gained. That's good. Wages are bad. And unemployment is a bit ugly. I mean, it fell to 4.6%. Sure, but also the participation rate fell. So it's a good headline for politicians. Well, elections are over, but for markets, it's not as meaningful. And other pieces of data, the ISM non-manufacturing PMI, which came out after the NFP, didn't serve as a hint this time. It jumped to 57.2. That's good news. The services sector is optimistic. Canada, the neighbor from the north of the United States, saw also stronger growth than expected, 0.3. They're still suffering from the low oil prices, but their jobs report was a bit mixed. They gained jobs that was better than expected over there in Canada, but most of them were part-time jobs. Moving across the Pacific, Chinese Caixin PMI, the independent measure of Chinese manufacturing, remains at slow growth territory, 50.9 points, just above the 50-point threshold. Bad news came from the land down under. Tonight, the economy plunged by 0.5%. And the Australian, remember that Australia never, well, the last time it had a recession was in 1991. And since then, it did have a few sort of separate incidents of quarters that saw contraction, but never 2 quarters in a row. One of the definitions of a recession, a technical recession, if you wish. It's worrying news. We've seen the Australian dollar fall, but there are hopes for a significant rebound in Q4. So it's just probably just one blip. We'll have to wait and see. Completing our worldwide tour here in the old continent, we had the German factory orders leap by 4.9%, but this is quite a volatile indicator. And the UK services PMI also beat expectations, 55.2. As in the US, the services sector is also key to the UK economy. Okay, what do we have in our upcoming days? Today is Wednesday. We'll start from events coming up on our radar today. We have UK industrial output. It can be a bit confusing because we have the monthly and month-over-month and year-over-year figures released at the same time, and we also have the manufacturing, a subset of an industrial output released also. So it can be confusing. Should keep the pound busy, but not necessarily set a new direction. We have a rate decision in Canada. No changes expected. There's no reason for Pelosi and his team in Ottawa to make any changes with the uncertainty about fiscal policy in the United States. And they're also in a neutral stance. They might cut rates sometime in the future, but that seems a bit distant. Their fresh forecasts, of course, will matter. Canadian dollar also strengthened recently, which is not what they want to see, I guess, but it didn't go too far. Oil inventories, so it's a big day for Canada today. Well, every Wednesday we have these inventories and see if they continue rising. And with this inventories report, I would focus on production. US production has been on the rise recently. And let's see if this continues. Just before midnight GMT, we have final Japanese GDP. These figures there are significant revisions over there, but the Bank of Japan has already made its big decision back in September, so it shouldn't have quite an impact. Dollar yen is moving mostly on the mood of the US dollar rather than the yen these days. Tomorrow, well, overnight actually, we have Chinese trade data, closely not for the bottom line, but for the top lines of exports and imports. More is more activity, economic activity is good, not only for Australia, which is sometimes seen as the proxy for the Chinese economy, but for the whole world. Remember that Chinese yuan has been devalued against the dollar, but is stronger against other currencies. Trump vowed to label China as a currency manipulator. I don't think he'll really do that, as with other election promises. Actually, China is fighting against the devaluation of the yuan. The big event, anyway, is the ECB's decision. It comes at 11:45 GMT, but the big event, the real show, is the Draghi show at 12:30 GMT. ECB President Mario Draghi will take the stage for an hour-long press conference. I think I have my times wrong here. Sorry for that. It will be 12:45 for the decision and 13:30. That means 1:30 GMT for the press conference. Okay, we got that fixed. And at the same time, we also have the weekly jobless claims in the United States of America, the weekly release. And Friday, relatively quiet day. We have the UK trade balance, which has been ballooning, and the consumer confidence preliminary it can give us some kind of view on the U.S. economy after the elections. I think many Americans are relieved that the elections are over, but some, of course, are in grief. And as well, it's not only about the elections. We've seen a divergence between the CB consumer confidence and this one from the University of Michigan, which has been a bit more cautious. Let's see if this continues. In theory, consumer confidence implies future retail sales, but it isn't. It ain't necessarily so. Okay. All right. Now let's begin our technical segment, starting with the majors, major currency pairs. Let's look at the charts. Here we are with euro dollar, the king of currency pairs, currently at 107.17. Very slow morning so far, hovering above this 107.10 level, okay, which was support back in December 2015. Just below this line, we could mark here 106.90, 106.80. It's a bit crowded over there. Anyway, 107 does not really work as support, despite being a round number. Further below, we have the previous low of 105.70, the initial post-US elections low, and 105.20, despite the breach earlier this week, remains a strong line of support, the last barrier before the 13-year low of 104.60. So these are the lines to watch on the downside. If we look to the upside, I still stick with 108.20, which was another low back in March 2015. Sorry, March 2016 this year. And we almost reached 108, which is a round number, but I stick with 108.20. Above this, we have 108.50 and 110, of course, a round number. As you can see from the wider chart, the daily chart, we found quite a bit from the highs. Just on an election night, euro dollar traded as high as 113. We're still in much lower ground. It still looks like a correction or even a dead cat bounce. Certainly not a change, of course, for euro dollar. Let's move to pound dollar. We'll, of course, focus more on that later on. Currently 126.20. Here we are on the move. This is the daily chart. We're seeing pound dollar retreat from the highs, some kind of renewed dollar strength. But the reason mentioned, of course, soft Brexit pushed the pair higher. In terms of technical levels, we got closer to the 127.90 level, which was the initial post-Brexit low in late June this year. Didn't really reach it. 127.70 was the high, and now we're beginning the retreat. 126. 126.60 is some kind of resistance at the moment after the recent fall. Looking further below, 125.85 is another line worth mentioning. 125.20 is already a much stronger level of support. If we look even lower on this popular currency pair on cable, we find quite a wide range there under 125.15. The next level is 123.80, and the last line for now is 123. To the upside, if we do break above the post-Brexit low of 127.90, I would mention 128.50 and 130, of course, the round level. Dollar yen, once it picks a trend, it never stops, but at least now it's consolidating. Maybe it has some altitude sickness there just under 115. Look at the spectacular rise from election night from 101 to almost 115. Anyway, 113 is the current bottom of the range. Let's add this important round number here. Further below, we have 112, another round number, and 111.40, which is a really, really strong line of support. Look at the way it separates ranges, serving initially in mid-November as resistance and later on as support. To the top side, we have 115 and then 116, which used to be a line in the sand for the Bank of Japan. So we have quite a few round numbers here on dollar yen, another popular currency pair. Moving to commodity currencies, Dollar CAD, Canadian dollar strengthened. That means dollar CAD. Dollar CAD fell quite a bit. 132.40 is the low we've seen recently. Yeah, works as some kind of support. To the top side, we have 133.60. It's a bit choppy. Canadian dollar is a bit harder to trade if you focus only on technical lines. Further above 134.80, which proved itself quite a few times in the past, and also late in November. It means last week, and further above 135.60. Capped the pair in mid-November, and it's followed by 136, a round number. Further below, we have 130 as well, of course, a round number, which also worked pardon me, as support and resistance quite a few times. So I would say between 132.40 and the current and 130, we have very few lines. It used to be, yeah, this pair, as you can see, is quite choppy. Still looking for a direction. Aussie dollar suffered the GDP release and also other events that strengthened the dollar earlier. Currently at 74.30, 73.65 serves as support, followed by 73, a round number. Further below, we find 72.50 and 71.75, but these levels haven't been tackled since the summer here in Europe, not summer in Australia. To the top side, we have 75, a round number, which works as a great separator of ranges. As you can see, we had a swing low to 75 back in October, and now it serves as resistance. Next up, 75, 80, and 76.50. Kiwi dollar found its footing just above 70, and then managed to grind its way back up. 71.80 serves as resistance in the immediate line to watch. 70.50, which was a double top many months ago, could turn into some kind of pivotal line here in the range. Looking further above, 72.65, 73.60, and 74.20 are lines to watch. Under the 70 level, we have 69.50 and 68.80. And dollar Swiss, not my favorite currency, the Swiss franc, currently at 190, 10090 to be precise. We managed to top 102 only for a very short time. 102.20 is resistance, high above. Of course, the level of parity is was a swing high in October and also serves as support at the moment. 99, 98.50, 98 levels to watch in an area where the pair passed quite a few months. Anyway, currently above parity, I would mention 0060 to 101.70 as the current range. But remember, the Swiss National Bank intervenes here quite a lot. Okay, so that concludes our major pairs. And now to the crosses. Okay, many traders like pound yen, but we'll begin from the worst cross. That's Euro Swiss, an area where we were seeing intervention. So Euro Swiss fell quite a bit, reached a line that seemed to be like a line in the sand for the S&P, the 107.60, went as low as 106.85. From there, it's been moving up, perhaps away from the spotlight. The S&P is intervening. Resistance has been reached here at 108.50 in the pair. It was the pair was rejected from this level. I would mention 107.60, 108.50, but in general, I would expect, if everything else, if things remain quiet, I expect the pair to trade in range. The range is 108 to 110 in a very choppy manner. Much more interesting, Euro Pound, 85 at the moment. Looking up, we have 85.90, 86.50, 87, and very, very strong resistance there at 88.80. Okay, we already topped 92 back in October, but since then the pound has strengthened. Looking down, 83.35 and 82.20 are lines to watch. Euro yen, quite volatile as well. So we had this range trading here between 112 and 116.25, and in November we had a break above this line, crossed a few ones on the way up. 123 is the next level of resistance, currently at 122.50. Further resistance 123.70 and 124.40. Looking down, 118.50 and 117 are lines to watch. And the favorite cross for retail currency traders, pound yen, the dragon, the gepi, currently at 144.10. 146 is a level we've seen this week, and I would see it as strong resistance to the top side. Another line here, which is a bit more problematic, is the swing high seen back in July of, let's put this line, 143.20. The round number of 140 serves as support, followed by 137.50. We'll conclude our technical segment of the crosses with price of oil. WTI crude oil cannot be ignored, of course. 52, or let's be precise, 51.80 double top was breached. I see it as a false break. These things tend to happen, and currently we're back at the $50 handle. 48.9, the high seen in August, is support, followed by 46.50, 44.4, sorry, 44.50, sorry, 42.50, and well below it we have the low seen in August. August was a crazy month at 39. We can expect some more room to the upside, especially if we have Russia also declaring that they're in, but afterwards we'll have to wait for the implementation for further gains, because if they don't implement the deal, then oil prices will fall back down, and I'm skeptical about the deal because in the past all countries, OPEC and non-OPEC members, have violated their commitments. Okay, so this concludes the crosses segment for our show this morning. Any questions? No. And now the ECB preview. Here is Mario Draghi. In one picture he's smiling, in the other one he's frowning. He is known as the magician, Mario the magician, the Draghi show that drags the euro down. You never know what's going on with him. And he lost some of his magic earlier in the year, but now kept his cards close to his chest, raising the tension and the speculation. So, what's going on in Europe? Some background. Inflation remains low, 0.6 on headline inflation, which is a bit too low, despite stabilization oil prices. Core inflation is even more frustrating, not budging from 0.8. Growth is slow at 0.3. At least we have some growth in Europe and not a contraction. When Draghi entered his job, it was the second recession of 2011, 2012. Unemployment is falling. That's a genuine piece of good news. It fell under 10% in the wider scheme of things. And even in Spain, it dropped under 20%. Italian banks are in trouble, especially after the Renzirendum, a referendum in Italy. His compatriot Renzi is down but not out. Anyway, we'll surely get questions about that. And the Eurozone can withstand lower exchange rate. Okay, so currently at 107, 108, even parity is a level which still helps exports, of course, and doesn't push inflation too high. In the UK, we had inflation. We had the pound falling too fast, triggering higher inflation and a change of mind from the Bank of England, which moved to a neutral stance. Okay, anyway, the background for this meeting is that Draghi promised us details about the QE program. This is an important decision. It's not like October, and September was also important, but in September he kept us in suspense, promising action now in December. The big question is the QE program, quantitative easing, or in other words, printing money, as you can see here. The program is currently running, well, it's running since March 2015. It was enlarged in March 2016, and currently stands at 80 billion euros per month. It ends officially, was extended from September 2016, and is expected to end in March 2017. We're getting closer to March. The ECB is currently buying mostly government bonds, sovereign bonds, but also some kind of corporate bonds. The program has two key limits. It has quite a few others, but let's focus on these ones. The ECB limits itself according to the country's GDPs. That means it cannot buy all of Greece's debt and buy less of Germany's debt, and has more limits here, and so it has to buy according to each country's GDP. It also depends on the issuer, on the issuance, and they cannot buy bonds which have a yield under 0.40. Yields bonds which have a yield under the ECB's negative deposit rate. Okay, these are the self-imposed limits of the ECB. What are what are the options standing before the governing council of this Frankfurt-based institution? The baseline scenario is extend the program, continue it in its current pace up to September 2017. That means repeat what they did in the past, add another 6 months. That's the baseline scenario. That's basically priced in. It should not move the euro too much if this happens. The euro should not move too much if this happens. Another option is begin tapering it down in March, moving it down from 80 to 70 to 60 to 50, doing what the Fed did with its own QE program, QE3 or QE Infinity. That would be euro positive because it's not, of course, it's not priced in, and it would mean less printing of euros and a higher value for the common currency. The other side of this, the other scenarios, is the extending the program by 12 months or even more to infinity, saying we'll buy as much as needed and we'll let you know when we intend to stop it, taper it down. That'll be, of course, euro negative. Even 12 months, extending it to March 2018 will be negative. And they can also do other things like loosen their self-imposed rules. I don't see it as quite likely because yields have risen. One of the advantages the ECB has at the moment is that thanks to the bond route, as some people call it, the sell-off of bonds, mostly US bonds, but also other places, yields have gone up. Higher yields mean there's less scarcity. Scarcity has been a problem. In many press conferences, Draghi has been asked about it. So the ECB can continue buying bonds at, has enough stock of bonds to buy in, so it won't need to loosen the rules, okay? So with more bonds available for buying, with weak inflation, I expect them to add more stimulus. That means at least extend the QE program by 6 months. Other things to watch out for in the hour-long press conference. We have in December, as in March, June, and September, we have new forecasts for inflation and for growth. If it's, of course, more pessimistic about inflation, about growth, then it's, of course, negative for the euro. If it's more optimistic, it can imply tapering, ending QE, and it's good for the euro. And the question is also the tone, not only the forecast, the numbers, but also the tone. Is Draghi more pessimistic or more optimistic? He might be a bit more optimistic as we're entering the holiday season, but you really never know. He's going to get bombarded probably with political questions about the implications of Brexit, the implications of the referendum. Here's a picture of his compatriot Matteo Renzi. There are lots of elections going on in the Eurozone next year. France, the Netherlands, and Germany, of course, stand out. there will be also questions about if the ECB's policy has reached an end, if there's nothing else to throw to lift inflation. And of course, Draghi is going to deny it. No central bank wants to admit that they're out of ammunition. And of course, he'll call on governments to do more fiscal stimulus. The European Commission has moved in this direction, but the ones that really call the shots, that means um, um, the ones that really call the shots, Wolfgang Schäuble, the German finance minister, Angela Merkel, they are not really changing their minds about austerity, at least not now, maybe towards the elections in Germany. Okay, so let's conclude this segment. Basically, a 6-month extension is priced in. Should not have a big impact. 12 months will be negative for the euro. Tapering, of course, ending it in March will be positive. Anyway, if it's a 6-month extension, the tone and the forecasts will matter quite a lot for the next moves in euro dollar. There's also something to mention here, a low probability that they'll push back the decision to January. I'll mention that the initial QA announcement was made in January 2015 without new forecasts, but they hinted about it heavily in December. I don't see them postponing it to January. I see them I see Draghi announcing something right now. Okay, so that's the ECB's preview. And now our currency of the week, pound dollar. Soft or hard Brexit, that's the main topic. So we'll begin about that. Let's begin with the timing. So as we speak, during this week, the Supreme Court in the UK is discussing if Parliament should approve Article 50, if Parliament should make the declaration of the UK exit from the European Union. I don't see it as that important. Parliament will not vote against the voters, even if an MP is in the Remain camp or was in the Remain camp. His constituents, or at least the constituents of the whole kingdom, voted in a clear majority for an exit. So if it moves to Parliament, from the government to Parliament, I don't see that as making a big difference. It might delay things by just a bit, but not even. I see the deadline of March 2017. Everything happens in March, as well, being honored. Okay. Some, of course, wish for a cancellation, and that's wishful thinking. Again, even if at least not now. Okay, so it might have kind of a soft Brexit or an interim agreement, and maybe later, 5 years from now, a cancellation of Brexit. Maybe, but certainly not now. So the timing is still March 2017, and maybe even before that, maybe in February. Brexit style. There is a high level of confusion. We have the 3 ministers, Liam Fox, Boris Johnson, seen before, and David Davis, wanting a hard Brexit, but people that really matter, Prime Minister Theresa May and Chancellor Philip Hammond, are looking for a softer Brexit. What does it mean? Basically, if Britain stays in the single market, if it has access, more trade, or less. Okay, one solution is that Britain can get an interim deal, the EEA or a Norway-style deal, officially being out of the European Union, but still getting access to the single market and allowing for immigrants. That's what's pushed the pound higher in recent days. And that's different from what we heard from Theresa May in the conference. But as she said, she does not want running commentary on Brexit. So similar to Draghi, we still don't know many things. Let's move to the UK economy. So far, it's doing well or even great. We had in Q3 the post-Brexit quarter growth worth 0.5 was confirmed in the second read. PMIs are upbeat, especially services. Retail sales look good. Brits are shopping, and the employment level is very high. That means unemployment is very low. So if you look only at these figures, the UK economy is firing on all engines. There's always a but. new firms are eyeing other places. So there was this tech conference in London last week, and some venture capitalists said that they're. I mean, London has lost some of its charm because of the uncertainty, and there are other places like Amsterdam, Berlin, and also Barcelona as hubs for startup firms. Of course, this is only anecdotal evidence so far, and employment may have peaked if you look only at the level. If you look at the level of employment in general and the unemployment rate, things look good. But if you look at the more frequent data of jobless claims, they have begun rising, and this could be worrying. Maybe employment has peaked. Maybe there's a turning point. In any case, the effect of uncertainty is a delayed one. It's not that the economy stopped working on June 24th, the day after the referendum, but future decisions are, of course, impacted by Brexit. And this high level of uncertainty, which is mostly to blame from the government, of course, but is weighing on the economy. We still haven't seen it, but I believe that things will get worse later on. Anyway, for pound dollar, at least for now, it did find the bottom. And let's look at the pound dollar chart to conclude this segment of our special focus on pound dollar. So this is a Y chart ranging up to June. In June, we had it reaching 150 on the Brexit night, then crashing, trading in this range of just under 128 to 135 for quite a few months. And then in October, we had another big fall, including the big flash crash of early October. Since the flash crash, we did trade above 120. We had an initial lower range here. Let's zoom in just a bit. We had a low range closer to 120. I would say we had this 122, 123. 123 serves as support further above 123.80, 125.20, which is strong support. Worked nicely as resistance beforehand. 125.85, 126.60, and then we have the post-Brexit low of 127.80. These are the current levels to watch out for pound dollar, and as the wider chart shows, we have moved one trading range higher since the lows seen in October, and even two. Sorry, since we had a range for October, a range for November, more or less, and now in December we're in a slightly higher range. But note that this range is still below the range seen in the summer. Okay, and generally speaking, if you look at the bigger scheme of things, currently 126.25 from levels pre-referendum of 145, 148, it's still a huge fall. Okay, so that's our currency of the week segment, pound dollar. Let's preview next week. It's the week beginning December 12th, ending December 16th. So on Monday, we have nothing extraordinary, but remember, we can always have rumors about elections in Italy, tweets from President-elect Donald Trump, and any other surprises to move markets as they open on Monday. But in terms of indicators, nothing extraordinary. On Tuesday, we have Chinese industrial output. Let's see if the recent recovery in China, a recent uptick in the economy continues. We have UK inflation numbers. Watch out if PPI, if the producer price index reaches consumers. We also have the German ZU indicator, the economic sentiment from this German think tank. On Wednesday, that's the really big day, and we'll have the show early in the morning to get you ready. We have the UK jobs report. US retail sales, always a top-tier figure, this time overshadowed by an even bigger one. And we have also PPI oil inventories, and in the evening, the Fed decision. The Fed is expected to raise rates for the second time in a year, and the big question is, what will they do in 2017? In 2018, will they raise rates more rapidly because of fiscal stimulus? They actually don't know anything. We'll know probably only after maybe 100 days of Trump in the Oval Office. Anyway, their new forecast, their new dot plot, everything will be all right. Janet Yellen holds a press conference. This is a really important Fed decision for the hike, for the forecasts, and because of the uncertainty of the elections, we'll have a full preview for that next week. And of course, there will be a live coverage on FX rates. On Thursday, we'll have the hangover, the aftermath from the Fed. We'll also have a jobs report in Australia. A rate decision in Switzerland, no changes expected there. Retail sales in the UK, so it's quite a busy day, quite a busy week in terms of UK indicators. And we also have the UK rate decision on Thursday, so it makes it even more important. This is a less important decision. No Super Thursday, no quarterly inflation report, and overshadowed by the Fed. Nevertheless, Mark Carney makes his mark, as they say, on the pound. We also have US inflation, also a top-tier figure, but we'll have all the talk about the Fed taking over. We also at the same time have current account, manufacturing surveys, jobless claims. Quite a busy Thursday as well, overshadowed by the Fed, but still quite a few important events. And on Friday, relatively easy swing into the weekend with the final CPI from the Eurozone and some housing data from the United States of America. Undoubtedly, next week's big event is the Fed, probably the last big event of the year. Of course, we still have another week before Christmas afterwards, but I think hyping the Fed, creating some hype around the Fed is justified indeed. Okay, so that's the next week's events. All right, and now let's wrap up the show. This is the wrap up for the live market open for December 7th, Wednesday. Getting close to the holidays, but very, very busy. Big events in markets. Everything ready for the Fed decision next week. In Italy, after the nice recovery, after the referendum, we had another sort of a setback, fresh worries. OPEC oil prices, once again, we had oil rising, gushing higher, thanks to the surprising decision that they reached an agreement to cut, but now, again, doubts are beginning just a bit to creep in. And of course, tension is growing towards tomorrow's ECB decision, which we previewed in detail. Hopes for a soft Brexit, well, also petering out as well. In terms of data, we had the non-farm payrolls not rocking the boat too much in terms of the Fed decision. A big event that we had tonight was the Australian GDP that plunged. We had a small fall in the Australian dollar. I believe we could see even more because it's quite a disappointment. Elsewhere, things are a bit more upbeat. In Canada, in the US, in China, things are looking okay. The big event, well, for today we have a bit of a focus on the Canadian dollar with the rate decision from the BOC and oil inventories. And tomorrow's big event is, of course, the ECB. Join a live coverage. Valeria Bednarik, Mauricio Carrillo, and I will cover the event. No changes expected in rates. The big question is, of course, the QE program. So in short, 6-month extension is expected, priced in. If this is the case, the outcome for euro dollar will depend on the tone, on the new forecast. It's a big rate decision from the ECB. If we have no extension, a tapering down, it's positive for the euro, quite unlikely. If we have a 12-month extension, a dovish Draghi, then the dovish Draghi will drag the euro down if it's 12 months or more. So that's the big event for tomorrow, and I think for the week. And then we have a relatively quiet Friday, but the last word belongs to the University of Michigan's consumer confidence. If we look quickly at the chart, we're seeing mixed, no trend. If we look at euro dollar, we're seeing it ticking a bit up after reaching support there at 107.10, basically, but lower than the high seen post Renzirendum. Pound dollar, we're seeing a move to the downside. Hopes for a soft Brexit, not as strong as they used to be. Watch out for 125.20 and 127 90 is the big lines. On euro dollar, under 107.10, watch for 105.70 into the top side, 108.20. On dollar yen, another important pair, 114.13, the current level, 115. I would say 113.80 to 115 is the current range. Dollar CAD, as I mentioned, important day, 132.50 to 133.60. Current range, Aussie dollar, 74.35 at the moment. Quite resilient in the face of the aftermath of this terrible GDP number. Anyway, 73.65 to 75 is the current range, and Kiwi dollar in the background, 71.25. The range is 71 to 71.40. That's the narrow range, but I would say between 70 and 72. Okay. So I guess that's a wrap up for today. We've seen the dollar consolidating quite a bit, even correcting after the Trump rally. I believe we might be seeing the end of this correction. We might see the dollar resume its strength towards the Fed decision, but time will tell. Anyway, that's it for our show for today. Thank you very much, everyone, for coming. As usual, you can see the full show and the separate video clips we'll make out of it on FX Rate and later on Forex Crunch. Wish everybody a safe and successful trading day, and see you in the ECB coverage tomorrow. Thank you, and bye-bye.